Okay, I think we're going to get started. My name is Marcia Trump, and I'm the Chief of Party for the CEADIR project, which is a climate economic analysis for development, investment, and resilience. I picked up on some of those words too. That's a long name. But basically, it's a project that started in 2014, and it's a project that emphasizes how to build the economic and business case for investing in clean energy, sustainable landscapes, and adaptation. It's a project about $20 million. It goes through September 2018 for those who are here in the audience and don't know about the project, as well as those who are online. And I want to welcome, in particular, the online audience. We always have anywhere up to 100 or over. And I know that I've already looked at some of the people who are online right now. There's quite a few, obviously, from Africa, and several projects in Africa, as well as some of the banks in Africa, too. So with that, I'm going to pass it over to my moderator. But the way that we work this is fairly simple. We have presentations, and we have a great group of people today that are going to be talking about the political and the credit guarantee to boost clean energy investment, in particular looking at African region. What's important about this is we've got people here that really help you structure the deals. They really help bring in that insurance and the other guarantees to make sure that these projects can go forward. And a lot of the emphasis of CEADIR is working with financial institutions on the climate financing side, mostly public but also private sector. And that's just been really critical to make these deals happen, to make transactions happen. So with that, I'm going to pass it over to my colleague Nadia Chern, and she will give you a few slides, but then also do a few brief introductions.
Thank you to everyone attending in person via webinar. Today's CEADIR series discussion will be on political and credit guarantees to boost clean energy financing in Africa. And I think this is a theme here today because there can be some political and economic reforms. But at the end of the day, if there are not some strategic, well-targeted financing products, those types of reforms are very difficult to implement in the long run. So I'm going to first start by introducing our panelists, and then I'll do a brief presentation before I'll leave the floor for each of the panelists. So on my left here, our first panelist is Marlene Hurley. She's a director in political and sovereign risk at OPIC. She focuses on energy investment insurance and reinsurance for all OPIC-assisted countries. Previously, Marlene was a vice president at the U.S.-Russia Investment Fund. She holds an MBA in International Business and Finance from George Washington University and an MA in Russian Studies from the University of Graz. Our second panelist is Marcus Williams. He's the global head of energy, oil and gas, and mining at MIGA. He provides political risk and credit enhancement guarantees for energy and oil and gas projects in emerging markets for MIGA. Most recently, he was lead operations officer for power and oil and gas at MIGA. Marcus holds an MBA in finance and marketing from the University of North Carolina, Chapel Hill. Our third panelist is Andrew Gisselquist, who is an investment officer at USAID Development Credit Authority. And he'll explain a little bit more what they do. But previously, Andrew was an electricity sector consultant for U.S. regulators. Andrew holds an MPA in International Energy Management and Policy from Columbia University. On the first slide, on slide number 4, my presentation. On this slide, it's very small, but what is very important here to notice is that when we see the global trends in energy financing over the last 10 years, the region of Middle East and Africa have very small amounts of financing for the energy sector. And out of these, it's mainly South Africa who has had a growth of over 300%, and this is mainly due to the energy sector reform in South Africa over the recent years. But the rest of the region, especially in sub-Saharan Africa, have had very small increases in energy financing. What's important is to understand what is the energy gap what are the needs for energy in Africa? Currently, there are 621 million Africans that do not have access to electricity. And another important data is in Africa, the poorest households spend 20 times more per unit of energy than the wealthiest households with grid connection. So the off-grid, non-solar, versus the grid connection. In addition to the 621 million Africans, there is going to be a growth. Today's growth in Africa is on average a little bit less than 5% for the whole continent. And that on top of this just normal growth, the population is expected to double by 2050. There's also rising income, and that the urbanization rate in Africa will increase by 50% by 2030. Under all of these different scenarios, the current growth trends in Africa will only be able to reach universal access to electricity by 2080. On the next slide, on slide 6, this is a little bit of a controversial slide because it shows a range of how much is now, depending on the first I discussed on the previous slide, the needs of energy, the energy gap, and now here are the investments. There are different sources of data and different reports, and I'm mentioning 4 different reports here based on different data from McKinsey, from Africa Progress Panel, from Brighter Africa. And what we can see is that annually the investments in power sector range for Africa between $33 to $77 billion. So there's a wide range gap. But what's important is that over the next, since 2014 until 2040, so over a range of 26 years, the need for energy investment in the sector ranges from almost 850 to over $2 trillion dollars. And this also is another range, is that with these investments, the target electrification rate can range from 71% to up to 100%. What is important to take out of this is that as of today, the ODA, or donors, and public funding are limited to meet these challenges. They can finance a little bit less than $10 billion annually, their capacity. So what is needed really is the private sector investment to fill the gap. And how can the private sector be attracted to fill in this gap, to structure this, and to find innovative solutions to finance these types of products? And this is a little bit where we'll be discussing these types of alternatives with the 3 panelists here. As a final, on my final slide here, I've put a selected USAID energy initiative in Africa. And what I'm showing here is Power Africa, which is a 2013 energy initiative, which focuses on bringing together African governments, the private sector, the U.S. government, to reach the shared goals of increased energy access across sub-Saharan Africa. The objectives for Power Africa are to increase electricity generation capacity by 30 gigawatts and increase electricity access by at least 60 million new homes and business connections. Within Power Africa, CEADIR, which Marcy was mentioning at the beginning, our program has 2 specific missions in Africa. The first one is to work with local commercial banks in 8 West Africa countries, which are mentioned here on this slide, to expand clean energy finance. And this project is managed by the USAID West Africa Regional Mission. The second program is to increase USAID Development Credit Authority guarantee use for off-grid and small-scale financing. And this project is managed by the USAID Power Africa DC. And my colleague Andrew here will discuss a little bit more some of these DCA structures. So without further ado, each of the panelists will be discussing or presenting their different specific financing products and case studies. So I'll hand the mic over to Marlene.
Very much, Nadia. It's a pleasure to be here. Thank you for inviting me. OPIC is the Overseas Private Investment Corporation. Emphasis is on private. We are a U.S. government agency. However, we mobilize private capital to help address critical development challenges. in more than 150 countries in the world. We manage a portfolio of $20 billion of projects in more than currently 100 countries, and we operate on a self-sustaining basis at no net cost to the American taxpayer. It's one of the biggest secrets about OPIC. OPIC has 3 different types of product lines. The first one is political risk insurance, which provides protections against political risks, including currency and convertibility, expropriation, and political violence. I'll go into detail a little bit later. We provide insurance contracts to U.S. investors and other investors on a fixed premium, locked in for 20 years, and can be canceled only by the insured investors. The second program is debt finance. We provide limited recourse financing over long-term financing for private sector commercial projects. We have a special program that supports small and medium enterprises, including impact investors. And the third product line is investment funds. Here, OPIC provides senior debt for private equity funds, which are selected through a competitive process. Once they're selected and the debt has been provided, the fund managers make the independent investment decisions, and all projects, of course, have to be approved by OPIC. For all these product lines, we have a cap of $250 million, which is quite significant and is very good for renewable energy projects, which don't tend to be so large. On the renewable energy side, for the past 6 years, we've had a focus on renewable energy projects. Between 2010 and 2015, we have supported 85 or more than 85 renewable energy projects across emerging markets. That basically is $1 billion per year. In 2016, we've had a little less than $1 billion, but nevertheless, a total of 95 projects so far. I am with the OPIC Insurance Group, so my presentation will focus a little bit more on the political risk side. So how do we define political risks? That's a risk, that's a threat that political changes in a country may affect the profitability or even the viability of an investment. We distinguish among 3 major categories of political risks. The first one is inconvertibility. That means the inability to convert local currency into US dollars, for OPIC US dollars, and transfer earnings to the home country. The second is expropriation, which is defined as an act or a series of acts by a foreign governing authority that deprives the investors in its fundamental rights in the investment. And expropriation can take different forms, from outright confiscation and nationalization all the way to severe regulatory changes and creeping expropriation. Political violence focuses on the risk of violence caused by political actions to assets and business income, and can include anything from civil war, declared or undeclared war, to terrorism and sabotage. OPIC, as a U.S. government agency, has, of course, a mission to support U.S. investment going into emerging markets. But we have a second mission, and that is to provide support to U.S. private insurers. I'll talk about that in a moment. So when we say U.S. investors, we have a specific definition of them. They can be either U.S. citizens or not-for-profit organizations established in the U.S. If they are corporations, they would have to be established in the U.S. and owned more than 50% by U.S. citizens or corporations. If the entities are established outside the U.S. jurisdiction, then at least 95% has to be U.S. owned. I also mentioned that we have a growing reinsurance program to fulfill our second prong of our mission, which is to support U.S. private insurers. So we work on the reinsurance side, we provide reinsurance and co-insurance to U.S. private investors as well as public insurers such as MIGA, and we work with MIGA on quite a few projects. We can reinsure U.S. insurers up to 90% of the exposure. So in other words, if there is a project that does not have U.S. investors in it, but a private political risk insurer approaches OPIC for reinsurance in any particular country, we can provide anywhere from 25 to 90% of the reinsurance. What types of risks or what types of investments can OPIC insure? Essentially, we insure any type of investment where the investor is exposed to political risks. That includes equity for retained earnings, repatriation of capital, and subordinated debt. We support outright debt, that's bank loans, bonds, capital, or operating leases from financial institutions. Assets, if a project is constructed and the investor is primarily interested in protecting tangible property. We provide insurance for private contracts, such as contracts among private parties for services such as construction, procurement, management, technical assistance, or franchise agreements. We also provide insurance for contracts with foreign governments or state-owned entities. That includes anything from bid bonds or guarantees, advance payments, performance, tangible assets used to perform a contract, for example, to construct a hospital or to construct anything, loans to governments or state-owned enterprises or government contracts for goods and services. Here we provide arbitral award default coverage where we require the investor to go to an arbitration process. I have one slide here that provides quite a typical structure for reinsurance. It's a very simple structure with just a few investors and one insurer. For a project we recently underwrote in Senegal, it's about a 30 megawatt solar project in Santiago, and the primary insurer here was Ace Bermuda, which insured the Meridian Africa Investments, SAS, a fund which also obtained senior debt from OPIC's investment funds program. The investors in this case were, as I said, the fund, then the local developer, Synergy, and the Sovereign Fund of Strategic Investments for the government of Senegal, with the French lender Proparco. The total project cost was about $48 million. And so this structure involved no U.S. investor, but it involved a U.S. insurer. So we were able to provide reinsurance to the U.S. insurer who had approached us, and we are currently working with them on another project similar to this one. For one thing that is very, very important to take into account when working with OPIC, but I'm sure it's the same thing as working with the World Bank, we look at the environmental and the social impacts of any project, whether it's a solar project or a hydropower project or any other project. And it's very important to focus that on that early on, because it can take time depending on how much work has been prepared by the investors. So generally, OPIC is very, very focused and very interested in renewable energy projects because they typically support countries that have middle or low income. That's our focus. And we continue to look forward to working with investors around the world to get these projects completed. Thank you.
Okay, thank you. That's fine, thanks. Okay, well, thank you all very much, and thank you for hosting us here today. Much appreciated. So I thought it might be useful to just give you a quick sense of the World Bank Group and how MIGA fits within that, because I think it tends to be something that is not widely known, particularly vis-a-vis MIGA. And particularly because guarantees are a slightly unusual instrument. I think they're sort of a crucial instrument, but a lot of people don't know much about guarantees as opposed to, say, financing, which everybody's aware of. And so it might be useful to have just a little bit of background. So the World Bank Group is made up actually of 4 separate institutions. And if you look at the slide, you'll see the 2 on the left, IBRD and IDA, are what we collectively know as the World Bank. They essentially work together. The staff who work there work on, in theory, on both IBRD and IDA countries. The distinction is that for the IBRD countries, this is the wealthier set of developing countries, and the CEADIR countries are the less wealthy countries. And this is where the bank goes in and provides either lending or grants directly to the government. So it's very much public financing. I think last year they did about $56 billion of financing into our member countries. The IFC is essentially the investment banking arm of the World Bank. World Bank Group runs on its own sort of autonomous fashion. We each have our own balance sheets, and they make investments, both equity investments and loans, quasi-equity, etc., into private companies and private enterprises in member countries. And then MEGA is the guarantee arm, and all we do is provide guarantees. And really, what we're doing is we're standing there. Our mandate is to encourage private investment into our member countries, and what we're really doing is acting almost as a proxy, I think, for the governments. So if you're a private investor and you're putting an investment into a country, we're basically vouching for the fact that all of these risks that Marlene was just discussing, which are very similar for MEGA, that the government is not going to come in and somehow interfere. And if they do, then we would make you whole, and then we go and deal with our shareholder and resolve the difference behind the scenes, as it were. So the idea is that it takes the non-commercial risk away from your decision about whether or not you should be making an investment in that country. Unlike the World Bank and the IFC, which have a multitude of products, MEGA has the luxury, actually, of having just this one product line. All we do is provide guarantees. And those guarantees really fall into two particular buckets, the political risk insurance bucket and the non-honoring of financial obligations. And just to quickly explain what they are, political risk insurance is really for private companies that are making investments directly into projects. Typically, this is done on a project finance basis. As you saw from the introduction, my particular focus is on power projects and oil and gas and mining projects. And almost invariably, these projects are done on some sort of a project finance basis, which is to say that it's a project that is financed and is developing its own cash flow in order to essentially pay for itself. And so these risks that we have here, which we articulate really as 4 different risks, with breach of contract, which I think OPIC can cover, but described slightly differently, being the risks that are available. And really, what these are, if you're an investor thinking about making an investment in an emerging market, these are the things that you're primarily worried about. This is what concerns you. The second bucket is the non-honoring financial obligations, and this is really to support banks that are lending directly to either to governments or to municipalities or to state-owned enterprises, and to help them with their financing needs. I've got a couple of examples at the end, and I'll show you how that works. The one thing that's important here is that, and I don't know if there are any financial institutions in the audience or on the webinar, but really what we're doing here is we're providing a credit enhancement for the government. So a bank lends to the government, and we are basically committing that if the government doesn't pay it back, then we will step in and make that payment. And that releases the bank from various constraints that they may have, either internally or from a regulatory point of view, about being able to provide that financing. But because it's basically a credit enhancement, we have a limit on the countries where we can use this, and it's based basically on the sovereign credit rating of the country. And we have a threshold of BB- as a country rating. This is quickly just to talk about why people, I think, come to MEGA. I mean, I think the biggest reason is really that you've got an investor who is sitting there thinking about making an investment in a country and trying to, as I said, try to work out how to deal with the non-commercial aspects of the project, which typically, if you're a project sponsor, those are the things that you are less suited to dealing with. You're building a cement factory, for example. You know how to run a cement factory, how to go through everything that's needed to set that up, to get your raw materials, to distribute it, and so on. But what you don't know is how the local environment is going to work, and if it may in fact work against you at some point. I think going to the point about being sort of a stand-in or proxy for the government. I think one of the main reasons that people would come to MEGA, and I think this applies certainly for OPIC as well, is we have the ability to go in and fix problems. At the end of the day, if something goes catastrophically wrong, we can compensate an investor or a lender for the money that they put into that project. But the idea is to avoid that happening. Instead, make sure that the moment a project appears to go off track, to try to do whatever is necessary to get it back on track. We have the World Bank Group has the World Bank has a AAA rating, IFC does as well. MEGA's not rated, but we have an implied AAA rating, and that has an important sort of benefit for banks, for example, that are looking to lend into projects, but I think also for companies that have to go through their risk committees to make investment decisions. We have a strong balance sheet, so in the end if we have to pay a claim, we're able to do that. Strong risk appetite, which is to say that we view our job as really going into the hardest countries and to doing sort of the longest tenors to really try to catalyze investment into those places where it's most needed. And then I think also the environmental and social risk mitigation. I think that when you go in with the World Bank Group, I think it's true for the US government as well, you are required to subscribe to certain environmental and social standards, which I think are generally viewed as being sort of best practice really around the world, and sort of standard setting for other multilaterals, for example. At times, I think that used to be viewed as a maybe even as a deterrent or something to get past, because people see these, perhaps rightly, as being expensive and time-consuming. But I think increasingly today, and certainly I think the US investors who are very focused on, particularly public companies, they're focused on their shareholders, and they're focused on, I think, their public image and their own corporate sense of social responsibility. People want to be able to demonstrate that the projects that they're doing in developing countries are being done in a responsible way. I think that's increasingly, not only important, but a requirement for many companies that are going into, and certainly, to be honest, the kinds of companies that we want to be working with and promoting. This just gives you a quick snapshot of how we've been growing. This is, I think, our annual new issuance every year, and this, I think, shows our portfolio as it's been growing on a sort of a stock basis. And I think what the sort of one of the messages here is that, going back, I think, to the introduction, that the need for private capital, I mean, the gap between what is needed and how to pay for it in developing countries is obviously vast. It's particularly large in Africa, but it's true, I think, in every region. And it's quite clear that there's not enough public financing to support all of that investment need, and so private financing is the way to get there. And I think there are tremendous investment opportunities and return opportunities for private companies, but also the risks are high too. And so, our aim is to try to find a way to take those risks off the table and sort of release this investment pool into the countries where it's really needed. We're a development institution at the end of the day, even though we operate on not exactly on a commercial basis, but we are set up in MEGA to be a transactions-oriented organization. In a way, we have two sets of clients: the host country government, but also the investors and the lenders who we're providing the guarantees to. And so we're very much structured. Our internal culture is very much really sort of a commercial culture, I would say. But the aim of every project that we choose to support is that it's going to have a developmental impact on the country, and often on the region where it's going in. And so some of the things that we look at, last year, for example, we did $4.3 billion in new issuance, new guarantees, which directly brought in an accompanying $27.3 billion. So there's a large leveraging effect or multiplier effect that goes into the guarantees, which we are definitely looking to achieve. But we then look at sort of the actual impact of the money that's going in. How many people have been, granted access to power? How many? What's the value of local procurement of goods? How many people have been employed? How much tax revenue? These are the sorts of things that we're looking to achieve when we're helping a project enterprise in one of our member countries get off the ground. And I think this is just some of it. I think the indirect benefits are much greater. They're hard to exactly quantify, but I think they're very real. This looks sort of like a slightly frightening slide, but I wanted to give you an example of just how a typical project may work. And this was sort of an important project because it closed last year in Nigeria, and it actually was a sort of an important project for not only Nigeria, but I think for a lot of the other countries in Africa who are looking to bring on IPPs, independent power producers. There was a model at one point that all power generation would be owned by the government, which was neither sort of efficient nor particularly realistic, I think, in almost all cases. And so more and more governments have been looking to, and this in many countries this has been going on for a long time, but to privatize the generation of capacity. So you get somebody to come in, build a plant, and then the country typically will buy it and then distribute it. So what happened here, and I think this is interesting because it shows how the different parts of a project all sort of come together. If you look at the blue sort of block in the center top, these are really the investors, the guys who are putting in equity money into this project to make it, to get it off the ground. They then went out, if you look to the left now at the lenders, they went out and they bid out requests to borrow money from a collection of different lenders, one of whom actually is the IFC, actually at the very bottom, who is our sort of sister institution within the World Bank Group, who are responsible for really bringing together the public side of the public lending. There's a blend in the lending group of both private banks and also development banks like KfW, the German Development Bank. So collectively they're putting in all of the different funds that they needed to build the power plant at the end of the day and everything that's required to get it to be operational. But along the way, there were a couple of other things. I think that investors really and lenders, when they're looking at a project, there are lots of risks they're looking at. But in some ways, it can be distilled to two categories of risk. The first is that once you've got this power plant up and running, how can you be sure that when you present an invoice to the state-owned off-taker, which in this case is NBET, which you see on the bottom right, how can you be sure that they're actually going to pay you for the power that they're taking off? To address that risk, this LC bank was put in place. The government was required to put in place basically a line of credit. So this was funded to the tune of, I forget what now, but maybe 6-9 months worth of those invoices. So if at any point the off-taker, NBET, couldn't afford to pay for the power it was taking, the lenders and the sponsors had the right to go directly to that line of credit and draw on it and get paid. Obviously, it's a temporary sort of band-aid, but it's enough to sort of keep things going before you actually end up having sort of loan defaults, which then triggers a whole series of events that leads to a sort of a shutdown, a termination. The World Bank provided a guarantee on that facility, on that line of credit facility, and if you know anything about how the World Bank Group guarantees are set up, and most people don't, but there are different guarantee instruments that are provided by different parts of the World Bank Group. And the World Bank has a guarantee that is specifically designed to deal with that risk. And one of the things that's useful about it is that that guarantee tends to be tied to not just the project, but also to a whole policy dialogue that's going on with the government. So in many countries, but including in Nigeria, what you see is a whole stream, sort of a chain of institutions and agreements that really need to be operating to make this thing work. You have a generator who's providing power, but then you need to have transmission lines that are owned by a transmission network. You need to then have the power distributed to households. You need to have bills and invoices sent out and then collected, and then the whole thing has to sort of find its way back to the people who are ultimately, with everybody being paid along the way. So the World Bank is often involved in helping the government think through that whole integrated chain of sort of progress. NIGA then came in and provided a guarantee at the top left to the commercial banks. And what we're doing here is we're providing a guarantee, again, as Marlene was saying, against very much those same kinds of risks. But we're providing specifically, I think most importantly, a guarantee against the second big risk that the investors are worried about. The first being that they're not going to pay it on an ongoing basis, but the second being that if the the whole thing does fall apart and it goes into a termination, typically what happens is it then goes into arbitration. The investors want to make sure that at the end of that process that they're getting their money back out at that stage. So it's sort of complicated shop, but it gives you an idea of how all these different parties come together and how the risk is sort of shared out. I think this is the last slide. Actually, I'm going to skip this one, but on the South African slide, slide 26, this is just an example of the second. At the beginning, I said that we've got these two buckets of guarantees, the PRI and the non-honoring. This was a non-honoring deal that we also did last year, where Deutsche Bank and Mizuho were lending to Eskom, the South African utility, to help them finance transmission lines, actually. And the government of South Africa provided a guarantee that they would get paid back, and we provided a guarantee that in the event the government didn't step in and make that payment, that we would pay them back. So I think with that, let me stop and let me pass it along. Thanks a lot.
Great. I'm good. I can look up at the big screen. Thank you. And thank you to all my colleagues up here, Nadia and Marlena, and maybe especially Marcus, who walked through that project finance example, so I don't have to. So that was really very nice of you. So I'm Andrew Gisselquist. I'm with the USAID Development Credit Authority, or DCA. And it's not up here on the slide, but maybe let me say a few things here about how we differ from OPIC and some of the guarantee products offered by the World Bank. So what they talked about is sort of for the power sector, a very well understood product that banks, love, because they're, as Marlena and Marcus mentioned, they're able to take a large percentage of the risk on these projects, 90–95%, and that then allows international financial institutions to come into a country that's very difficult to operate in and be willing to take the remainder of that risk. We have a little bit of a different model, the vast majority of what we do, at least at DCA, where we're looking to share the risk equally, oftentimes with a local bank, oftentimes on much smaller individual loans, maybe a portfolio of individual loans. So what we're looking for is not so much like OPIC does, supporting U.S. Nexus, U.S. investors, U.S. entities, or maybe people are familiar with U.S. Exim or other export credit agencies, where the goal is to support that content and jobs in a particular country boosted by exports. We don't have those requirements. We're here as part of USAID to support the development objectives of USAID and to work with a variety of financial institutions, but most typically local financial institutions, and sharing the risk 50-50 split. So we're helping them move a little bit farther into sectors or borrower groups that they wouldn't otherwise support. So maybe they're only lending to the largest companies in a country. We'll help them work with SMEs. Or maybe they haven't done anything in the power sector before, and we'll help them lend to individuals or households to pay a few $1,000s to get connected to the grid finally. So it's a little bit of a different model. We are moving more and more over time into the space Marcus just talked about and Marlena talked about with larger projects, especially as we work a lot with Power Africa. But our bread and butter is really guarantees that share the risk and work with local banks for the development impact. So as I mentioned, we're really aligned with USAID. We are embedded in USAID. We work and receive most of our transactions from USAID missions on the ground, who really have that local expertise, and it's a great network to be able to build off of. And then we're able to pair our guarantee, or rather the missions are able to pair our guarantee with existing technical assistance, such as the CEADIR program here, to support lenders and borrowers in getting ready for the commercial finance that we help facilitate. So as I mentioned, there's no requirement for the US Nexus or content. We're really about the development. But we do remain backed by the U.S. Treasury. So we're housed within USAID, but our guarantee is tied to the U.S. Treasury, so it still has that same high credit rating. As I mentioned, it's typically a 50% pari passu, equal risk-sharing guarantee with the banks. We can, or other lenders. We can work with a wide variety of entities from local, maybe MFIs or credit cooperatives, local banks, international, regional or international banks, funds. We can work in local currency or dollars, euros. So we really value the flexibility of our tool. We, as it says here, we're not eligible to guarantee sovereign debt, but anything non-sovereign, which includes even municipalities. Some of our earliest guarantees were of municipalities in South Africa, helping them access the capital markets. And we can also work with state-owned entities, which is pretty important in the power sector. As long as they're commercially operating, as long as we can view them as a parastatal entity and not simply an arm of the government, then we can work with them either as a borrower or in certain circumstances as a lender. We do, as all these entities do, we do have fees that we charge, a couple fees upfront, origination fee to make sure that there's some buy-in from the institutions that we're partnering with, and an ongoing utilization fee. Perhaps what's a little bit different than these other tools is that fees have most of the time heavily subsidized. So the local USAID mission will take a portion of its budget and set it aside essentially with the Treasury, essentially buying the guarantee from the Treasury. And then the guaranteed lender will contribute some funds as well to that guarantee and help offsetting the cost to the USAID mission and ensuring that they have some skin in the game as well. And what this does is, as my colleagues up here have talked about, it really helps then leverage budgets. As we saw earlier, there's not enough in Nadia's presentation, there's not enough funds out there for the development agencies to get everything done that needs to get done out there. So our typical leverage is about $1 of USAID budget up to $20 of private sector lending. That's globally a broad average, and it varies obviously country to country and project to project. But it allows us then to have the impact that our missions are looking for, even in an age where budgets are increasingly stretched thin. And I should mention we do work globally. So I'm on the Africa team focusing on power, obviously, but we work across 75 countries and have facilitated close to $5 billion of lending with close to 500 different financial institutions. So we do have that reach, even though our average deal size is somewhat smaller maybe than OPIC or MIGA. And really, we are trying to be responsive, as I mentioned, help support local demand, but and build up the capacity of institutions, but also be responsive to their needs. So, like I mentioned, that we can do U.S. dollar lending or local currency lending. We have several different structures. Our most common, by far, is the loan portfolio guarantee, where we have an identified lender and a type of borrower that we've identified, or a qualifying borrower definition. But then beneath that, there's no confirmation or check that needs to be done when the bank makes the individual loans. So they can go out and do their typical credit process and evaluate, maybe a small medium enterprise, maybe an individual, and make that loan. As long as it ends up meeting that qualifying borrower definition, they can then upload that information into our system and go about their business. So again, we're trying to integrate ourselves with their standard operations and help take a little bit of the risk off their hands so they become more comfortable moving that next step into a slightly riskier sector. We also do, and this is increasingly what I'm doing in the power sector, loan guarantees where we have an identified borrower and an identified lender or lenders, and we do our due diligence on both sides of that transaction. And whereas our loan portfolio guarantees, there's quite a wide range in the size of those. They may average around $10 million of lending that can be done under that guarantee. The loan guarantees that I'm looking at are typically somewhat larger, in the tens of millions of dollars. And we can go up. Last year, we had the largest guarantee in our history of $200 million of lending, a portfolio guarantee that was in South Africa. So we typically don't look at anything below $5 million. So that's sort of the range of guarantees we're looking at, 5 up to 100, 200 million dollars of range. And increasingly, we're looking more and more at more complex structures like those that Marcus walked through, bond guarantees, supporting local bond guarantees where possible. It's often a heavy lift, but we're excited to engage in that and help support the capital market development, even beyond the sort of end borrower impact that we see and seek. So let me talk through a couple examples, just very high level. These are, as I mentioned, a little more straightforward than what Marcus said, explained about. So here's one, and we are working, USAID is working with CEADIR on this project, the Pan-African Beyond the Grid loan portfolio guarantee, where CEADIR is providing technical assistance. This was a fairly standard guarantee for us in some ways, in that it was a 50% portfolio guarantee, supported a wide variety of actors in the off-grid renewable energy sector across 33 countries in sub-Saharan Africa. So we have multiple lenders that are engaged, reaching out to the sector, and we're supporting their lending up to $5 million for each loan size. And we are, I should mention, bringing on additional lenders to that guarantee, looking in a few countries right now, mostly in Eastern and separately Western Africa, as this sector really expands. It's an exciting place. The solar home system companies are really what most people are excited about. We're seeing that expand now from Eastern Africa, where it's been facilitated so well by the mobile money system there, and it's moving now into Western Africa and Southern Africa as well. So we're trying to bring on some local banks to make local currency loans that those growing companies are finding so difficult to source. And I mentioned, just skip. You can see the structure. We have several different lenders that are either in the guarantee right now or joining the guarantee shortly, most of which choose to remain anonymous. Here we have one family office that operates essentially as an impact investor, Kennyarth, who is very open about their participation, but the local banks often worry that if it is made known that they have a guarantee from USAID, there'll be some impact on repayments. So we work with them to keep their participation non-public. But you see, it's a very straightforward structure here, where the lenders are able to make those credit decisions that they see fit, and then we step in, providing a 50% guarantee of the principal on that debt that the lenders offer, should there be a default there. Again, it's US dollars or local currency as they see fit. And one other structure here, support that we've done now 3 times, supporting access to finance for grid connections. So this is, speaking here, it's an example in Kenya, where we worked with a local Kenyan bank to provide liquidity down to a savings and credit cooperative who really has that rural outreach and has those more regular contacts with individuals and households who may be looking to borrow that last $1,000 or $2,000 so that they can pay the fees to connect to the grid. They may be relatively close to distribution lines or transmission lines, but they need to make that additional payment so that line can actually be run to their house, and so they can pay to have their house wired. And that's what this tried to do, really getting funding down to the local level and loans down to the local level, where that lending can be most directed at those individuals. And then reporting comes back up the chain from the SACO to the bank to USAID on the number of connections that have actually been facilitated through this. So we guaranteed that local Kenyan bank, Chase Bank, making the loan to SACO, and so we're facilitating that liquidity there, and it supports, again, Power Africa's goals of adding new lending connections. So you'll see here it's pretty straightforward that we're sitting in between the commercial bank and the SACO, we've done this now twice in Kenya, and I just implemented another guarantee like this in Uganda, where we're sitting between two local banks there and the actual loans that they're making to the individuals. And again, these guarantees are typically supported by technical assistance from the local USAID mission, working primarily with the lenders to help them get up to speed on lending in this sector, help them create their lending product, help them promote their product as well, potentially facilitate connections between them and the local distribution utility to make marketing their product a little bit easier. So here it's a standard 50% guarantee lasting over 5 years. Our guarantee can go much longer, but we find most of our partners choose guarantees in sort of the 5 to 7, 8 year range. And so we're really working, again, with the marketplace to try and support their needs. And I'll just end here. A variety of contact information if anyone is interested in reaching out, learning more about the DCA product. I have contacts for the Africa team, myself included, as the power sector lead and the point of contact with Power Africa, and then some team leads from our other regional teams as well. I'll end there.
Dana, all panelists here, Marcus and Andrew, for each of your explanations. And I think it really addresses to some extent the point that I was making at the beginning, which is really this energy gap and how can we attract private sector investments at a catalyze. And I think that the different products of the institutions where you work really are able to implement that. Today we have approximately on the webinar more than 60 people attending. Participants are from countries such as Cape Verde, Ghana, Germany, US, Canada, Jamaica, Colombia, UK, Thailand, India, as an example. So I think we have a very diverse global interest in Africa and investing in Africa, and what are the different products that could be used to invest in Africa. Some of the institutions that are represented are Power Africa, USAID, Ghana, West Africa, Jamaica Missions, Clean Power Asia, C4All, EDC, ICF, Selco Foundation, Mercy Corps, as an example. And before we go to the questions that could be in the audience, and also some of the questions that we are being received online, I'd just like to ask a general question to all of the panelists. I think that what we've been seeing is that Africa is in dire need of energy. There are 621 million people that are without energy. There's at the same time, there's a vast boost of different types of technologies, foreign technologies that are going into Africa, that are entering not only to connect the grid, but really in the last few years to really go off grid. And the cost of technologies, especially solar, has gone down. So there is more possibilities, more structures, even at the government level, to really, in fact, boost clean energy through different types of structures. And I think that one of the questions that I would have is, what do you see as providing in these financing instruments, which could be lending or guarantees, as the main challenges to overcome this timid private investments and really to scale it up at a larger scale, because there is a large need for that. So.
From OPIC's perspective, we provide both finance and insurance and our investment fund support to all these projects. From our point of view, the project has to be commercially driven. It has to be commercially sound. Project finance is done on a limited recourse financing basis, so we only look to the project for repayment. We have to make sure that the investors and the lenders that are involved in the project and the development companies have experience in similar projects and possibly in similar markets, that they have a good reputation. We have to always do background checks on that to ensure that that the investor community and the investors in the project are basically comply with the basic requirements, including Foreign Corrupt Practices Act, the U.S., and we're very strict about that. But it really, the project we support, they are investor-driven. So it is perhaps we are able to provide coverage, we are able to provide financing to many more such projects, but we have to review them on a commercially, on the basis of are they commercially sound, and how can we get the word out that we are there and that we're interested, and basically we are very responsive to investors' needs, so we just welcome good projects.
Yeah, I think I would point to two things that are sort of impediments. I think that in most countries in Africa, I think maybe it goes back a little bit to what we were talking about before, but there needs to be a sort of a basically a supply-demand reckoning. And I think in many countries, you have these enormous figures of how many people don't have access to electricity, what the shortfall is. But as I was saying before, you need to have a systematic and coordinated approach to bringing on new power. It needs to be, it's easy to say you just need new power, but the country has to be able to absorb that power. And there has to be really a sort of a plan to bring new power on in a steady way, so that it can come online, it can then be transmitted, it can be distributed to the places where it needs to be distributed. And there are many countries where that kind of rational approach is just absent. And I think that's where USAID and other parts of the government, the US government, NCC, for example, have a huge role and have been doing incredibly important work trying to help countries come up with that sort of almost like a master plan. And I think if you are a solar developer, for example, and you are putting an investment project proposal together, you need to be sure that when you actually build a project which has perhaps a 25 year lifespan and vision, that it's going to work, it's going to fit within a system, not just sort of tomorrow, but for the future. So I think that's the first thing. And then I think the second thing is, honestly speaking, I think most of the customers for these projects are bankrupt. They're not creditworthy. And so there need to be structures in place to support them. And there are structures in place, and obviously, OPIC's one good example. I think MEGA, the World Bank, and others, African Development Bank is another. But there need to be things in place, like, for example, a system that's providing sovereign guarantees to support some of these offtake obligations. So I think those are the two things: a sort of a master plan, and then a way to basically make individual projects bankable within an overall sort of environment.
I would say maybe two or three things. I think if you're talking large power projects today, I'd agree with what Marlena and Marcus said, that there needs to be this functioning electricity sector in a lot of countries where payments actually flow up from customers all the way to the generators. And you often don't see that, whether it's partially privatized or whether it's a publicly owned sector and vertically integrated. So you definitely need to see that, and where that doesn't exist, if you're going to build projects, you need pretty substantial guarantees on them today, and that's where we are. But looking out into the future, ideally what you see is us getting out of the business, right? That at some point you can go out and build a project on purely commercial terms, and you don't need to spend 6 months or a year figuring out how you're going to incorporate a guarantee into the financial structure and making sure that your project gets picked by the national government as one that's going to go to a guarantee, or that you work within the government timeframes that happen to coincide with the budgets that they get out. So, I mean, that's probably quite a long ways off, but that is I think the ultimate goal that we're all probably working to put ourselves out of a job eventually, that we can help scale up the capital markets and the local capacity, and frankly help more lending happen in local currency as well, to sort of, instead of immediately we need to come up with mechanisms to help support and deal with foreign exchange risk, but eventually the best way to do that is not have that foreign exchange risk and scale up the local lending capacity. So that for certainly grid scale power projects, I mean, I think I agree today. It's exactly what my colleague, and then it's just having that long-term vision for where we're going to go and incrementally building that financial capacity as time goes.
Yeah. I think just before I open to the audience, I'd just like to add on to your question, Andrew. I think it's an excellent question, because at the end of the day, most of the countries in Africa, except the ones that have the currencies that are pegged either to the French franc, euro, and so forth, most have local currency, and there is not enough local currency capacity for all of these projects. So my question is actually twofold. I heard that DCA takes on FX risk, and maybe the OPIC and MIGA can also confirm if they do that, or how do they mitigate FX risks when they provide the guarantee. And the second question is, given the limitations in local capital markets, and given that even if we were to tap into private banks locally and internationally, there isn't still capacity for enough investments from that pocket of money to really finance all of the projects. How do you see that the products of your institutions can really develop or help at some way to develop local capital markets? Granted that in Africa they are at different incipient levels, so some are more incipient, some are more developed.
Yeah, I can say something quick about both of those. So speaking to the DCA product in particular and foreign exchange risk, there's not a straightforward, unfortunately, a straightforward mechanism that we have to handle that risk. What we do is basically two different structures. One will guarantee, hard currency loans, US dollar loans, and those will have then US dollar claim payments if there is a default. Alternatively, we can guarantee local currency loans, and we'll make local currency default payments. And through the magic of working with the U.S. government, we know that we can be able to convert the currency, so we don't face some of those risks that private actors would often have in a lot of the countries there. When we're working, it gets a little more complicated for us when we're working with larger projects, because we do, at the end of the day, have to have a cap on our exposure at DCA that is denominated in US dollars. So if you have a portfolio of loans, you only expect a small percentage of them to default, that's not a problem. If you have one larger loan, it's not a problem if the local currency depreciates, as is often the case, because we have more capacity in US dollar terms then to support the project. If there is an appreciation in the local currency, you just need to build in some headroom to cover that. So yeah, FX risk is still an issue. If you have a US dollar investment into a market where the revenues are going to be in local currency, that's still a concern and something that we take into account when we do our risk analysis on a project. If anyone else has something to add, I don't want to monopolize the time.
I mean, I think from Miga's point of view, I think on the FX risk, I think there are maybe two ways we do it. One of which is that we're able to provide a guarantee to an investor or to a bank that is hedging their own risk, and then they've taken out a swap. In that Nigeria Zero example, for example, we provided coverage on a currency. I think it was a currency exchange swap. We also cover interest rate swaps too. So that's one way we can support the project, hedging its own currency risk. The other way is that, in theory, and I didn't really mention, but we haven't actually paid very many claims. I mean, we've done, I think, close to 900 projects. We've actually only had 8 claims in Miga's history, in almost 30 years, of which only 6 of them were war and civil disturbance, which tends to be something that it happens before you really even know it's about to happen. There's no real way to mediate those sorts of things. And to be honest, it sounds serious, and I guess 1 or 2 of them sort of were, but a lot of them were really what one might almost describe more as vandalism than as terrorism, or true civil disturbance. Politically motivated, which is the key, but still. But and then we've had 2 expropriation events, but we've never actually had a transfer restriction claim. But in theory, I think what would happen is that if an investor has earned revenues from the project, takes it to the central bank, wants to export, take it out of the country, so that they can pay their debt or pay dividends to the shareholders, and for some reason they can't, the central bank either blocks them or tells them we run out of hard currency. Neither would, in theory, take the local currency, compensate them outside of the country with hard currency. And then we've got various ways of using that local currency within the country if we have to, including the fact that the World Bank is very often lending into the country as a lending program, so we can do some sort of an internal transfer. So that's maybe a long answer to the foreign currency question. And just on the debt capital markets, I know that what I discussed here was very much focused on the power side, but we're split up into 4 different sectors, and one of them is the financial markets and financial services capital markets team, and we provide a lot of coverage to banks that are very often lending into their subsidiaries in a country, and then the idea being that is to provide capital for the subsidiary to on-lend into the local market. And I think from a developmental point of view, that one can argue that there's actually nothing that's more developmentally powerful than that. I mean, you can argue about it, but it clearly has a hugely systemic importance to an economy that's trying to grow. Mm-hmm. And so that provides financing that then becomes available for SMEs, for local banks that maybe then trying to invest into projects. So that's how we try to expand and support local capital markets.
Mm-hmm. And from OPIC's point of view, it's a mix of what Andrew and Marcus have just described. On the lending side, we have to grapple with the exchange rate risk as well, and so we take that into account in our risk analysis. On the insurance side, similarly, we provide insurance for hedges for bank hedges against currency risk. On the inconvertibility insurance, I think we do very similar to what you do. We have limit periods where we do not take actually the exchange rate risk per se, because it's really a protection for inability to convert and to transfer. But it is, as I said, we do provide insurance for hedges, and we are also thinking on the finance side on local currency loans, but that is not yet developed, but it's something that is recognized as being very important, and we are thinking about that. Okay. Very good. So I'll start by opening up the questions. Eric?
Two questions for Andy, which is, first, what is the typical, after you negotiate a guaranteed amount, what is the typical percentage uptake rate on that? And then what is the DCA experience with guaranteed payouts, and how does that compare to the guaranteed premium?
Yeah, good questions. I should know this. We had our annual retreat about a month ago where we had a big presentation on the state of our portfolio. And our team that monitors our portfolio walked through all of that. So I'm sort of trying to pull from memory here. I would say for our expired guarantees that have run their course, I think the average utilization rate is somewhere in the 70 to 80% range. So it's pretty good. That obviously varies a lot from guarantee to guarantee. We'd love to have, as much as possible, 100%. And then to your other question on our default rate and how that compares to the amount we've set aside, maybe with the U.S. Treasury, our default rate is something about 2.7, 2.8%, something in that range historically. And that is roughly equivalent to the fees that we have charged for our guaranteed parties over time. And that is very, very much smaller than the amount of subsidy that USAID missions have added in over time. So the model that we're given from our regulator is quite a conservative one compared to our experience. So it's a very different picture than, say, I know a little bit more about OPIC than I do about MIGA's model, where you have your own default curves. Unfortunately, we can't yet use our historical experience to calculate those, so our model's quite conservative in that. So we're essentially even on our cost to the U.S. taxpayer.
Okay. Good. I'll start with a question now from the webinar. I'll just go with the webinar and the audience if needed. So I think there's two questions for Midlena of OPIC. The first one is, can you elaborate a bit more on the insurance to the contracts with foreign governments? Are those contracts between private investors and foreign governments? And at what point does OPIC insure them?
Sure. We can certainly insure private contracts between private parties. That's a given. But we have also been insuring contracts between private companies and foreign governments, or state-owned enterprises in various sectors. And so when that happens, we take a look at whether there is a government guarantee associated with it, but we can insure a project even when there is no strict government guarantee, but it is in a contract with a state-owned enterprise. What we do require in that instance is, because it is very difficult to sort out whether a dispute, whether a non-payment is due to political issues or commercial issues. And so we require the investor to go through arbitration. We recommend that the arbitration be in a, that it be international arbitration, the reputable arbitration court. And then if then the investor wins an award and tries to enforce it, but the foreign government counterparty does not pay the award, then OPIC makes the claim payment. So that's how it works. In that context, we also provide insurance for denial of justice, where the government entity or the government frustrates or thwarts the efforts of the investor to go through the arbitration. So in that case, after a certain period, after the investor has tried everything they can to take the government entity to arbitration, we would pay a claim. Okay, very good. And then the next question for OPIC is, how does the provision of OPIC risk mitigation instruments translate in CapEx within local capital markets? And subsequently, how will local banks and developers benefit from it? So it's really important to keep in mind that political risk insurance mobilizes private investment. So if I'll take the example of Synergy, the case study that I provided earlier, I showed you earlier, where we had a local developer who was actually really getting everything done locally, getting the PPA signed and so on, but they needed private capital, and investment funds, private equity funds, are looking for investment opportunities, but would be hesitant to deploy their capital in certain markets without political risk insurance. So that brings these two parties together. That's how we see our value added here. Okay.
Yeah, I think this is an important question. Is you were explaining about the development impact effects, and one of the questions on the webinar is the MIGA investment flows. How do these MIGA investments, how do they flow down to SMEs? Is that run through a government program or financial institutions? It's a little bit, I guess, a mix of how are they measured, or how can you really, palpably say that?
I think it's, so I think different projects have different kinds of outcomes there. I think that in the example I just mentioned about a banking deal where we're supporting a bank that is lending into a local subsidiary, very often, in fact almost invariably, maybe not invariably, but very often I would say, those funds will be earmarked for SME lending, and so we provide the guarantee knowing that it's always a little bit hard with the bank because with any project that we are guaranteeing, we want to know what the funds are being used for. We obviously want to make sure that they're not being used for anything that we would want to avoid, we wouldn't support, and on the other hand, that they are in fact being used for something that is productive, and also that it's going to be used for what they say it's going to be used for. But it's hard to tell with a bank because the money is fungible. If you see $100 million that's going into a local subsidiary, it could be. How do you decide? So what you do, and what we do, is we look at the overall approach that bank has in the country and try to make sure that they are, not only are they directing it towards worthy borrowers, but also on top of that they have, for example, their own standards about whether it's environmental and social impacts or anti-money laundering or various other provisions and sort of requirements that we would see as being important. I think on the power side, it's a lot more indirect. I mean, what we're doing is we're trying to make sure that basically, and again, there's a fungibility problem as well. But we look at how many megawatts, kilowatts per hour of energy, electrons are being pushed into the system, and then you try to sort of divine from that, how many new households are being connected, or how many businesses, how many people have benefited for how many hours a day, and within that, SMEs are clearly going to be a part of the beneficiaries of that additional power. But it's hard to be very sort of precise and
a challenge, an art.
Yeah.
I think that one question here that I'm seeing on the webinar, which is recurrent, and it's a question for all three of you, is with respect to what types of guarantees are being provided for off-grid energy projects. Because like I was mentioning at the beginning, this is where we've seen over the last 2-3 years the biggest push to really provide growth and electrification in the region. And just one question that would summarize it is to hear more on lending to or guarantee programs to decentralized small-scale projects, local entrepreneurs requiring much smaller loans. I think some of you mentioned about the portfolio, but I think in some cases it's more on a case-by-case. And what are the barriers, challenges, opportunities associated with these from a guarantor's point of view?
Sure, I can start with that, having presented on our Beyond the Grid DCA. So clearly that's one mechanism that Power Africa, using the DCA tool, has put out into the market, so supporting several different lenders in reaching out to those distributed energy companies, anything up to $5 million per loan, and that really grew out of Power Africa and DCA both being, a couple of years ago, starting to become inundated with requests from the solar home system companies where they're really growing. We had done a couple of guarantees, one-off guarantees with those individual companies, and we could see there was no way for us practically to meet the demand for that sector to do, half a dozen or more every year. So we tried to bundle them together and do a slightly larger guarantee. That one has 75 million of lending capacity in total under it, rather than $1 million here, $1 million there for these companies that are quickly growing. I think the question sort of touched on perhaps other projects. I don't know if it was driving at mini grids or sort of micro hydro. The difficulty guaranteeing those is very practical, that it takes about the same amount of work to guarantee one of those as it does a much larger project or a much larger portfolio. And so it's really difficult to find a project of that scale to do a one-off guarantee where it really makes practical sense. As I mentioned earlier, we're not looking to do anything that's below $5 million, which is still sort of pennies in the power sector. But some of the smaller projects that may support a small village would be even much less than that. And we've been approached by a few mini-grid companies that are looking to do larger portfolio of mini grids, maybe in the several kilowatt size, and I haven't yet seen a business model that really makes commercial sense. Again, we're engaging with commercial lenders, and U.S. government has other tools, grants and other products to support companies at an earlier stage. So I think that's really where that sector is today, at least in my experience.
Yeah, I would say that we haven't actually provided many, if any, guarantees to off-grid solar, which is, I think, it's not because we wouldn't be prepared to, we would, but we just, we've tended to, we've tended to focus on larger projects which have been based on, being able to contribute power to the grid. But we've certainly talked to people, and it's happening more and more. I think one of the concerns there, what I've seen in some cases where we've looked at deals and talked to investors is, off-grid can be great in many ways, and certainly if you're talking about, rural Africa, where the cost of getting transmission lines out to a remote site is obviously prohibitive. An off-grid solution can make a lot of sense. But I've also seen situations where you have investors coming in proposing to provide an off-grid sort of network, and that is there to provide power to, say, the few industrial companies that are actually paying their bills to the local off-taker. And that can then end up being very destabilizing for the country. And you see this, for example, in much smaller, like island economies, for example, where you may have, most people are not paying their bills or are being heavily subsidized. You've got a few, big companies that actually are making enough money to pay. So, you have to sort of look at the trade-offs there. I think the small guarantees, first of all, Andrew's point, it takes absolutely almost as much work on a smaller deal as a bigger deal. There's definitely not a proportional. So that's just from a resource point of view, that's an issue. At the same time, sometimes they can be simpler. You don't have these kinds of structures that I was looking at with the Azure deal coming up mostly. Sometimes you just have, an equity. It's an all equity deal, and that can in a way make it simpler. One of the biggest challenges for us as always as we're going through our underwriting, and I'm sure we all face this common experience, is we need quite a lot of information to be able to make a sort of a fair and honest and sensible assessment of the project. And just getting that information. And one thing that when we're dealing with the big banks and the big investors, they do have a lot of people and they have a lot of studies and they have resources to go out and get environmental impact assessments, for example. And sometimes that's more of a challenge for smaller investors. But for us, we don't have a minimum threshold. I think the smallest guarantees we've issued have been less than $1 million, certainly. At the other end, the largest is $1 billion. So I would say on average, certainly on the power side, it's probably a few $100 million. Across our portfolio, it's probably around $50 or $60 million. So, but going down to really quite small amounts, particularly I think in places like Afghanistan, for example, where there's not a huge amount of investment going in anyway, and so a big investment might be a $1 million investment. So we expect to, and for us then, going to the resource point, that's worth it for us to, or we will try to, happy to dedicate resources to doing a small project in that context.
I'll make it very quick. I agree with everything that Marcus and Andrew have said in terms of challenges for off-grid projects. OPIC does not have minimum, it has no threshold amounts for insurance. And we also finance some very, very small projects. Again, it comes down to the specifics of the project, how it is, whether it is viable and how it competes with others. But the challenges for doing small projects can be quite significant from the assessment of the environmental and social and worker rights impacts for that precise reason that Marcus mentioned, getting the information from the investors who are not used to that kind of rigorous process. That can be a challenge and can delay the closing, financial close, and also getting the insurance contract.
No, for sure. Okay. We have time for one last question in the audience.
Yeah, hi, Catherine Stratus. Just a few quick clarifying questions.
Marcus, you mentioned the development impacts, and you had a nice slide on that.
Yeah.
I really liked that, and I just wanted to clarify. Those are projected results based on the applications. Is that correct?
So
It's not like
it's a good question.
After the fact, after it was
So we do both, but actually
Okay.
you're right. I mean, that's projected based on,
Okay.
because those are the deals that we closed in in our FY16, which really runs from July to June. So the deals that we closed up until June 30th of this year. And those, some of them are going to be more real. Some of those figures are more real than others. I mean, the amount of, attendant investment catalyzed is probably pretty real because, those projects have gone to financial close. So that number will be known. But the number of the employment figures, for example, or the number of additional, people brought online for power, will be estimates based on, the sponsors' projections. But what we do is we go back and we validate those every year on our portfolio.
On a spot basis, or
No, on a collective, on a across our portfolio. It's part of our sort of contractual requirements. And one of the things that we have various covenants in our contract, and including how investors are expected to behave, comply with local law, for example. Pay your taxes and so on, but also one of them is you need to report back to us these sorts of issues. Or these sorts of statistics. And sometimes we see there's variation. I mean, the estimates are often not correct. They're often, sometimes they can be a little high, but very often they're actually quite conservative. I think people tend to want to be conservative when they're coming forward with their applications to us.
and also kind of on that once it's built
Yes.
aspect, I wanted to ask Andrew, there's this interesting product where households can get a loan in order to connect to the grid. Was an assessment done of the utilities' ability to support the grid and to support more connections? Has there been any reporting on, I connected to the grid and now it can't support me? I mean, I was just wondering if that aspect was looked at.
Yeah, it's a good question. Let me answer that taking a quick step back. So DCA itself has some reporting requirements around the loans that go out the door that are applied across our portfolio. And those may be, is it a first-time borrower? Is it a female borrower? Things of that nature. Those are pretty simple. And if we're looking at any specific development objectives, then we're going to look to our USAID mission, what they want to see out of that guarantee, and try and build that in specifically to the guarantee agreement that we have with the bank or lender to make sure that they're reporting those back to us. So in the case of, say, the guarantee I just did, very similar to the one I presented, that's pretty straightforward for reporting how many connections get made, because one loan typically means one connection, so you can just count that up. And to your question on whether the grid will support it, I mean, that's part of the due diligence that goes into the guarantee up front. That's part of why the concept comes to me in the first place from our USAID mission, that they want to work and support with the local utility in expanding their connections. They believe in it, and that's part of what we investigate as we sort of go through the deal as well. So it's certainly something that we look at prospectively, and then it really depends deal to deal what we're looking at after the fact. And it can be a challenge sometimes because banks, their typical loan product doesn't have these reporting requirements. So building that in is something that we do spend a lot of time doing.
Very much to everybody. I think we've reached the 90 minutes. So thank you to our audience. Thank you first to the panelists, excuse me. Thank you to our audience, to the webinar. And just as a quick conclusion, I'd just like to say that we've introduced here different types of political and credit risk guarantees that can be used to really boost private sector investments in the region, both in some cases, on-grid, off-grid. And there are challenges to receiving information, to structuring the deals, to environment, social, to regulatory, technical, macroeconomic as well. But at the same time, what's very important for all of these institutions, and it's more coming as a trend, or is a trend already, is really to identify the development impacts and to really be able to measure it, monitor it in the long run. And I just finalized with a special note on sort of next steps or something to take out of it, or what could be done, is to really see how we can develop local capital markets. Not only that, but also local technology to make it a sustainable environment in Africa. And I think within all of the institutions where you work, this is some discussions, of course, that have come into place and have to continue in that trend. So with that, I'd like to close and thank all of you.